Hello everyone. Today we're going to discuss HNDA fourth year Strategic Financial Management subject 2018 past paper question. Under 2018 past paper question, we're going to discuss capital structure lesson related question. First, we will discuss the question number 3A. Briefly explain the Modigliani and Miller capital structure theory. See the answer. This is the answer. The market value of a firm is irrelevant to its capital structure. In other words, the market value of a levered firm equal to the market value of an unlevered firm if they within the same class of business risk. Value of unlevered firm mean financing only through equity. Value of levered firm mean financing through a mix of debt and equity. The next question is, there are some advantages and disadvantages of borrowing a debt into capital structure. Critically evaluate above statement by using the trade-off theory. First, we will discuss the advantages of borrowing a debt. Next, we will discuss the disadvantages. This is the advantages of the borrowing the debt. The main advantage is the tax benefit because borrowing the more debt, they want to pay the more interest. So interest is the allowable expenses. The allowable expenses increases the common and tax benefit. Next, see the disadvantages. The main disadvantages of the borrowing the debt is the financial distress. Financial distress including the bankruptcy cost of debt and non-bankruptcy cost. Non-bankruptcy costs include staff leaving, supplier demanding disadvantages, payment terms, stockholder infighting, etc. You can see the financial distress. This gap is the financial distress. This is the main disadvantages. Next, we will discuss the question number 5A. Define the capital structure and what are the elements of capital structure. You can see the answer. Capital structure means the mix of long-term source of fund. The mix of long-term source of fund is the capital structure. There are main two elements, equity capital and debt capital. Preference shares, retained earning comes under the equity capital. Debentures, term loan bonds comes under the debt capital. Next question is, Star Manufacturing Company has a total capitalization rupees 1 million and it normally earn 100,000 before interest and tax. That means 100,000 is the profit before interest and tax. The financial manager of the firm want to take a decision regarding to the capital structure. After a study of the capital market, he gathered the following data. The three data are given, amount of debt they given, and also interest rate. That means cost of debt rate. Also given each amount of debt. Then also given equity capitalization rate. That means cost of equity rate. Also given each amount of debt. Then also given, assume corporate tax is a 30% and that firm always maintain its capital structure at book values. They ask the two questions. First one is the what amount of debt should be employed by the firm if the traditional approach is held valid. That means they ask the optimal capital structure. That means the best mix of debt and equity financing that maximizing the common market value or minimizing the weighted average cost of capital. So we want to calculate the weighted average cost of capital. Then we decide the which is the best mix of debt and equity. Let's see how to calculate the weighted average cost of capital. I already prepared the table calculation of weighted average cost of capital. This is a table. These four data are there given in the question: amount of debt, cost of debt rate, equity capitalization rate, cost of equity rate, book value of the firm. These four data are given: amount of debt, cost of equity rate, cost of debt rate, cost of equity rate, and total capital is also given 1 million. Then we want to calculate the amount of equity, weight of equity, weight of debt, cost of debt after tax. Then finally, we want to calculate the weighted average cost of capital. First, we want to calculate the amount of equity. Let's see how to calculate the amount of equity. This is the formula calculation of amount of equity. Amount of equity equal book value of the firm minus amount of debt. Book value of the firm minus amount of debt equal book value of the firm 1 million minus amount of debt is 100,000. So 900,000 is the amount of equity in the first option. Then we can track. So this is the amount of equity in the all options. Then we want to calculate the weight of equity. See the formula calculation of weight of equity. This is the formula. Weight of equity equal amount of equity divided into book value of the firm. Let's see how to calculate the weight of equity equal amount of equity divided into book value of the firm 1 million. So 0.9 is the weight of equity in the first option. Then we can track. So this is the weight of equity in the all options. Then we want to calculate the weight of debt. Let's see how to calculate the weight of debt. This is the formula of calculation of weight of debt. Weight of debt equal amount of debt divided into book value of the firm. Amount of debt divided into book value of the firm equal amount of debt is 100,000 divided into book value of the firm. So 0.1 is the weight of debt in the first option. Then we can track. So this is the weight of debt in the all options. Then we want to calculate the cost of debt after tax, because in the question they given the corporate tax is 30%. So we want to calculate the cost of debt after tax. Let's see how to calculate the cost of debt after tax. This is the formula of calculation of cost of debt after tax. Cost of debt after tax equal to I mean cost of debt before tax into 1 minus T mean tax. Let's see how to calculate the cost of debt after tax equal cost of I mean cost of debt before tax 3% multiple open the bracket 1 minus T mean tax rate they given 30%, that means 0.3 close the bracket enter. 2.1 is the cost of debt after tax in the first option. Then we can track. So this is the cost of debt after tax in the all options. Finally, we want to calculate the weighted average cost of capital. Then we want to select the lowest weighted average cost of capital, because that is the optimal capital structure. Let's see how to calculate the weighted average cost of capital. Weighted average cost of capital calculation formula under the traditional approach is weighted average cost of capital equal to cost of equity multiplied into weight of equity plus cost of debt multiplied into weight of debt. See the answer equal open the bracket cost of debt cost of equity is the 10% multiplied into weight of equity. Close the bracket, then plus, then open the bracket. Cost of debt after tax is 2.1 multiplied into weight of debt. Close the bracket, enter. So 9.21 is the weighted average cost of capital in the first option. Then we can track. Then we want to identify which is the lowest weighted average cost of capital. You can see 8.5 is the lowest weighted average cost of capital. So this is the optimal capital structure. Then firm select the which amount of debt is the 500,000 because this is the lowest weighted average cost of capital, optimal capital structure. So amount of debt is the 500,000. The next question is they ask if the Modigliani-Miller approach is followed, what should be the equity capitalization rate? Under Modigliani-Miller approach is the formula of calculation of equity capitalization rate. Equity capitalization rate equal to earning before interest and tax divided into total capitalization. See the answer, how to calculate the equity capitalization rate. Earning before interest and tax divided into total capitalization equal earning before interest and tax is the 100,000 divided into total capitalization is 1 million. So equity capitalization rate is the 10%. Then we will discuss the question number 6. First question is, what do you mean by the liquidity of a firm? How can the liquidity of a firm be assessed? See the answer. This is the answer, the meaning of liquidity. Liquidity means the firm's ability to meet its current obligation. A proper management of a liquidity ensures that the firm does not suffer from lack of liquidity and also does not have excess liquidity. The next part of the same question is, how can the liquidity of a firm be assessed? The firm assessed the liquidity can be assessed by using current ratio and quick ratio, and also case ratio, interval measure ratio, and working capital ratio also can be used. But current ratio and quick ratio are the main ratio of calculation of liquidity. Current ratio and quick ratio more than one, the firm ability to meet its current obligation on time, ability to pay its current obligation on time. But less than one, the firm cash flow could be in trouble. The next question is, how does the cost of equity behave with the leverage under traditional V and the position? That means Modigliani and Miller position. See the answer. First one is according to the traditional view, cost of equity remain constant, certain level of debt, certain degree of leverage. You can see the graph, cost of equity remain constant, certain level of debt or certain degree of leverage. Later, where the increase in the leverage, the cost of equity also increases due to the debt risk. Based on the Modigliani and Miller view, the cost of equity increase with the debt. The cost of equity increase with the debt is equal to the constant average of cost of capital. Equal to the constant average of cost of capital plus the premium for the financial risk, which is equal to the debt equity ratio times the separate between the constant average cost of capital and the cost of debt. The weighted average cost of capital and cost of debt remain constant. You can see the graph. I think all questions are finished. This is the 2018 past paper capital structure lesson related question. I hope you all are understood. Thank you very much. We will meet next video.